In this video, we're going to be going through how does your medical work? So how do I pay for medical in retirement? So we're going to break this down as far as what I need to do at 65 to get onto Medicare. What do I do if I'm retiring before 65? How do I actually pay for the medical expenses? So I don't want you to different programs and benefits you have available to help you with this. Okay, so let's work backwards here. So the first benefit that you're really working towards is Medicare. So remember that Medicare is not Medicaid. Medicaid is the free insurance that's income-based. Here in Washington, it's referred to as Apple Health. Medicare is different. Medicare starts at age 65, and you do pay an annual premium for it. Typically, they will withhold the premium from your Social Security check. So you get that Social Security check, you should see a line item that says deduction for Medicare Part B, and whatever you receive, you can spend. So it's kind of built into the Social Security system. So Medicare starts at age 65. Now, when you're enrolling in Medicare, you can't enroll until this age. So as far as when you can apply, so Medicare allows you to apply the month that you turn 65, as well as 3 months prior and 3 months after. Right? So I have the 3 months before I'm 65, the month I turned 65, and 3 months after. So 3 plus 1 plus 3, that's 7 months that you have available to apply for your Medicare. So what happens if I miss that enrollment date? If you forget about it and don't file in time, you can have an increased Medicare charge. So it's a permanent increase as a penalty for collecting your Medicare late. So this is not a deadline you want to miss. The good news is, like anything else, there are exceptions to the rule. If you are still working and you're still covered by your employer's medical, you can, of course, keep working. When you retire, you file for Medicare, there'll be no penalty in that case. Another scenario is if you're retiring, but you're covered by your spouse's insurance plan, then that also gives you the exemption to file for Medicare at a later date, right? So Medicare, that's the first one everyone's working towards. So when you're trying to figure out how does healthcare work, start with that, and now let's work backwards. So if you're retiring at 65 or past it, it's pretty simple just to retire, get onto Medicare, and then your medical starts. There can be a little bit of some lapse in time, so you do want to file a little bit early just to make sure things are all smoothed out with Medicare, so all the coverages start on time. So then the next benefit you need to understand is your PEB. So PEB is the Public Employees Benefits Board. Most of the state employees are already on this program. This is your primary healthcare when you're working for the state. If you are a school district employee, you guys are on SEBB, School Employees Benefits Board. So when you retire and leave the school district, you actually just switch over to PEB and SEBB stops. So PEB is what helps people pay for the healthcare in retirement as well as past Medicare as well. So let me tell you how this works. So PEB, so let's say I'm going to retire at age, let's say 60. So I can actually have the ability to get onto PEB. And when I get onto PEB, they're going to have what they call retiree coverage. So retiree coverage is typically going to cost you more than what you're paying on SEBB or PEB before. Because you're not working for the employer anymore, there's no one supplementing that premium, you're going to have to endure the full cost of it. Now, is PEB a good deal or not? It's kind of on a case-by-case basis. Typically, in my experience, PEB has been the best deal out there. And if you ever decline PEB coverage, you can't come back into it. So you want to make sure you do all your research before saying, I don't want any PEB coverage. So the retiree healthcare you get from PEB is when you continue after you separate service and are retired. You're going to pay the full cost of your insurance premiums. The second part of PEB is post 65. So let's call it 65 plus. So after you've turned 65, you're on to Medicare. You can actually still keep your PEB coverage, and it becomes your Medicare Advantage plan or supplement. So it's the second to pay. So you're on 65 now, you're on Medicare. Medicare pays first. Anything Medicare doesn't cover now falls under the PEB coverage. So because PEB is no longer the primary coverage here, the cost for this goes down. Typically, it's about half as much. Of course, that can vary year to year and depending on the company plan you choose. Now, there's a middle ground here for couples. So if we have one couple that say is under age 65 and someone else that's 65 plus, you actually can have kind of a split rate. So you follow this middle tier, the spouse that just turned 65 PEBB is going to be their second insurer, second to pay. For the spouse that's under 65, PEBB is still your primary insurance coverage. So there's going to be a little bit of cost savings there. And then once you're both 65, you're going to drop to that lower tier and the cost will decrease further. A couple other things to know about PEBB. In order for you to be eligible to enroll in PEBB, your employer has to be part of the PEBB program. So if you work for a school district, you're automatically enrolled. They're eligible for that. However, certain city employees, such as like the city of Kirkland, have opted out of PEBB coverage. So if you're retiring from one of those city entities, you want to double check with the employer to see if they're part of PEBB or not. If they are not, you cannot get on PEBB. Instead, you have to go through the healthcare exchange and buy private insurance. One other thing to know, if you're on Plan 2, so we're talking TERS, PERS, SERS, Plan 2, you have to start collecting your pension benefit before you're eligible to enroll in PEBB. Remember, PEBB has a 60-day window after you leave employment to enroll in it. If you miss this window, you're not eligible to enroll in PEBB. So with Plan 2, the rule is you have to collect your pension first before you can enroll in PEBB. So if you're trying to retire early and you didn't want to take your pension because you don't want to take that penalty, you're going to lose the ability to enroll in PEBB. So this is just one little nuance to consider if you're on Plan 2, whether or not you should take the pension early. All right, next, let's talk about how do I pay for healthcare, right? So now I know all my coverages and how they start, how to enroll in them. How do I actually pay for it? What's the most efficient way to do it? So paying for it, you have a couple of ways to do it. If you had a high deductible savings plan and took advantage of a health savings account, your HSA, you have the option to use this to pay for healthcare. There's also something called VEBA, which is a health reimbursement account. You can also use this money to pay for healthcare. And of course, if you don't have any of those options available, you're either going to pay out of pocket or you can look at getting a part-time job somewhere that offers their part-time employees healthcare coverage, such as Starbucks, Walmart. Those are some places you may want to check into if you're wanting some kind of part-time job that also helps pay for healthcare. Okay, so remember that money that comes from your HSA or VEBA is pre-tax, but as long as you use it for medical expenses, it's tax-free. So you can essentially use this money anytime to pay for premiums and not owe any taxes on it. A lot of employees will use this to transition from 62 to 65, help cover medical expenses until they can get on Medicare. This is a great strategy to use if you're low on cash. Now, if you're wanting to make the most of the HSA or VEBA and you don't want to spend it all in early retirement because you know things are a lot more expensive in your later years, you can always choose to use some of your retirement savings for this. So if you have money, let's say in the TERS 3 defined contribution plan, you could take some of this money to help pay for your medical costs. So if you are taking money from a taxable source, you're going to be paying taxes on it. So you want to consider that before using this to help pay for medical, but it could be an option for you to help defer taking money from the HSA or VEBA to try to maximize those. So those can actually grow and earn more tax deferred or essentially tax-free income to pay for future healthcare costs. All right, so last thing we're going to cover today is when it comes to using your VEBA to pay for the insurance. So you're going to have your insurance company, your insurance premiums. Then you have your VEBA. And then there's you, of course. So one thing to know is that VEBA, while it does cover healthcare costs, it cannot be paid directly to the insurance company. So you can't have VEBA cut a check and send it to them. You can't write it on a debit card. VEBA is a reimbursement account. So it reimburses you. So you can't say, hey, VEBA, send money to the insurance company. That is not going to work. What you need to do is you have to pay the insurance company yourself, and then you can take a withdrawal or a reimbursement from your VEBA account. That's the simplest way to do it. That can save you a lot of stress and headache, because a lot of people go into this with that misunderstanding that, yes, I can use VEBA to pay for healthcare, and they try to send a check, and then it bounces back, and they're behind on their healthcare expenses. So just avoid that up front. Just pay it from your own pocket, reimburse yourself later. The same is true for your HSA account. So healthcare can feel kind of confusing at first, but if you have someone that helps you lay out all of your options and how the time is going to work for you, it can make things a lot easier to understand and much smoother overall. If you need help building yourself a comprehensive financial plan, the link below this button is to get on our calendar. Look forward to speaking with you soon.